This is Nightly Business Report with Sue Herrera and Bill Griffin.
Hiring hits the brakes. The economy created far fewer jobs than expected last month, just 20,000. Is it a sign we've hit peak employment?
Building equity. If you're a homeowner, you might be a lot richer than you were just a year ago.
Bright idea. Meet the entrepreneurs who say the future of retail is a brick and mortar store, but with a modern twist. Those stories and much more tonight on Nightly Business Report for Friday, March the 8th.
Good evening, everyone, and welcome. The headline number was a shocker. 20,000 jobs created in February, well below the 180,000 estimate. The gain in non-farm payrolls was the slowest pace for job growth since December of 2017. But the unemployment rate did dip to 3.8% and wages ticked higher. And job growth in the 2 prior months was strong, leaving some to wonder if this is just a one-month aberration or a sign that the hottest part of the economy may be starting to slow. Steve Leisman starts us off tonight.
This was a miss for the ages. Wall Street looked for a reasonably strong jobs report of 180,000 created in February. The real number, just 20,000. The Wall Street economists haven't been this wrong since a 238,000 miss in November 2008. That is, in the middle of the Great Recession. But rather than fearing the worst, most economists think the number is more noise than signal.
This is about as internally inconsistent a report as I think that I've ever seen. And if there were ever a month where you want to wait till next month and see what happens, this would be it.
While job growth was low, unemployment measured in a separate survey fell. While the work week declined, hourly earnings were up strongly. So what's going on? One culprit could be a very snowy and cold February. Construction jobs fell by 31,000. The government shutdown ended the month before, might have played havoc with the data. It could also have been just a snapback from a really strong number in January, and every now and then, data can just end up being an outlier to the real trend. The danger is this wasn't noise.
I still do think the risk of recession is high for 2020, and I'm not as optimistic that even if we get a trade deal with China, that they can stimulate. The weakness preceded the trade weakness, and their ability to stimulate is not as strong as it once was.
We won't know till March if the number was right in pointing out a weakening U.S. economy, or, as many hope, it was way off target. For Nightly Business Report, I'm Steve Leisman.
Well, let's turn to Luke Tilley right now for more analysis of today's jobs number. He's chief economist at Wilmington Trust. Luke, good to see you. Thanks for joining us tonight.
Thanks for having me on.
So what do you think? Aberration or something else going on?
It's certainly an aberration in our view. It really doesn't fit with the other indicators that we're seeing in the economy. Principally, surveys of businesses indicate that they are still looking to hire, and also the number of job openings in the economy is at all-time record highs. So what we see here is a little bit of a statistical aberration, and as was suggested in Steve's report, probably a little bit of impact from storms and the government shutdown.
So you would disagree with those who say that we've reached peak employment?
Yeah, I don't think we've reached peak employment yet. We still have a very strong labor market in the sense that those employers are looking for workers. Really, the limiting factor on growth is their ability to find them. The unemployment rate is so low that they're having trouble finding them, and that's what's pushing up those wages to the 3.4% that Steve mentioned that is now high for this cycle.
But we are at a point now where the International Monetary Fund has lowered its growth targets for the global economy this year. The European Central Bank just this week lowered its growth forecast for Europe. We've been hearing about the problems in China and then our own economy as well. So aren't we at a point now where you would think that hiring would start to slow at some point?
We think it would start hiring. The hiring would start to slow at some point. We don't want to be whistling by the graveyard here. There are certainly a lot of indicators that we do have a slowdown in the global economy. We're not disputing that at all. We have a slowdown in the U.S. economy from about 3% growth in 2018. Wilmington Trust, we think it's going to be just 2% in 2019. But that still doesn't make this morning's job report very accurate. We still think it was an aberration. But we are looking at all of those signals: business investment, consumer spending, the next jobs report, to see if there is indeed a weaker economy ahead of us.
You're watching very closely participation from those in the age group of 25 to 54. Now, granted, that's a wide spread, but why are they so important in your work?
They're so important because they're a better indicator of what's going on in the labor force. So a lot of people will focus on the overall labor force participation rate, but that includes the baby boomers who are retiring of their own volition. That 25 to 54-year-old cohort has increased their participation dramatically over the past 2 years, adding millions of people to the labor force. That is the single most important thing going on in the labor market right now and is helping employers fill those positions.
Very good. Luke Tilley with Wilmington Trust. Again, thanks for joining us tonight, Luke.
Thank you.
On Wall Street, the stock market closed out its worst week of the year, just one day before the bull market turns 10. Today, that anemic jobs report did little to excite investors, as did new data out of China, which showed a 20% slump in exports from a year ago. Those economic growth concerns pressured stocks, though the major averages finished way off of their worst levels of the day. By the close, the Dow Jones Industrial Average fell 22 points to 25,450. It had been down more than 200. The Nasdaq was down 13, and the S&P 500 slid 5. For the week, the indexes were all off 2% or more. And we also want to look at the Transportation Index, which is now down for 10 straight sessions, its longest losing streak since 1972.
But there was some positive news on the economy out today. Housing starts rebounded in January. They were up more than 18% on a rise in single-family home construction. That followed 4 straight months of declines. And even though home prices have been cooling a bit recently, homeowners are still very much in the money. Diana Olick takes a look now on a new report that shows a big rise in home equity.
Strong demand for housing last year kept home prices surging, and that means more homeowners are sitting on more cash in the form of home equity. Collectively, homeowners with mortgages saw their equity increase by just over 8% last year, according to CoreLogic. That's a combination of value gains and paying down their mortgages. And it's a collective $678 billion, or about $9,700 per homeowner. Of course, all real estate is local, and so are the gains. Homeowners in western states saw the biggest annual increases in home equity, with Nevada homeowners now about $29,000 richer, and Californians just short of $20,000. Washington State, New York, and Florida also saw big gains. But there were losses. Homeowners in North Dakota, Louisiana, and Connecticut saw their equity drop. Rising equity also meant more homeowners who were underwater on their mortgages finally came up for air. The number of homeowners who owe more than their homes are worth dropped last year, but that number is still above 2 million. Rising equity often results in more cash-out refinances or second home equity loans, meaning more spending by consumers who feel more wealthy. That could translate into bigger gains for the remodeling industry later this year, as homeowners take out more cash just to put it back in for remodels or upgrades. For Nightly Business Report, I'm Diana Olick in Washington.
It's time to take a look at some of today's upgrades and downgrades. ExxonMobil's rating was cut to market perform from outperform at Cowen, I should say. The analyst cites concerns over its investment strategy. The price target is $75. The stock fell more than 1% to $79.01. Netflix was downgraded to neutral from buy at Buckingham. The analyst cites concerns over new competitive threats and the departure of its chief marketing officer. The price target is $382. The shares fell a fraction to $349.60. The cannabis company Tilray was initiated with an underperform rating at Jefferies in new coverage. The analyst cites the stock's valuation. The price target is $61. Despite the new rating, the stock rose a fraction to 70 even.
Still ahead, looking for some value in your stocks? Well, this week's Market Monitor has some food for thought on that subject. The United Kingdom is scheduled to leave the European Union in just 3 weeks, and still there is no approved plan that outlines exactly how that's going to happen. Now, that has created a lot of uncertainty for many businesses, especially those in the steel industry, which has been thriving. Willem Marx is in Hales Owen, England for us tonight.
Alex Cross has spent most of his adult life around giant slabs of molten metal.
35. And
He's the production director at Summers Forge in Great Britain.
how many people work here overall? What's your total workforce? There's around about 120 people.
Summers produces highly specialised steel products used in submarines, ships, and across the energy sector. And at this family-owned firm that dates back to 1697, business is booming despite Brexit uncertainty.
The steel sector here in the United Kingdom has a long and proud history as a global powerhouse. But experts say that its European Union membership that in recent years has provided bigger benefits to steelmakers in terms of propped up prices and increased employment than to any other UK industry.
In the event of a no-deal Brexit, the percentage of total UK steel exports facing trade restrictions, including tariffs, could swing from 15% to 97% by the end of this month. Higher shipping and admin costs could also total $92 million a year for steel exporters. Tammy Inglis is the FD at Summers. She admits US steel tariffs have hurt her firm's finances recently, but says a hard Brexit could mean much harder times for many peers.
Steel prices, I think, would fall. The steel industry would suffer. Summers Forge, I don't think would suffer.
Do you feel like you've had a partner in government, in a sense, that's helped you plan?
No, I don't think we've had the visibility that business needs. I think because the way that Summers operates, we haven't felt the adverse impact of that. We've still invested, we've still recruited.
For firms with a weaker pedigree and cash position in an industry that's already feeling the squeeze, no politician can promise Brexit won't spark significant and lasting damage.
For Nightly Business Report, I'm Willem Marx.
Hales Owen, England.
A big move higher for Big Lots, and that's where we begin tonight's market focus. The bulk discount retail chain reported better than expected earnings and revenue. The company also saw same-store sales rise more than 3% for the second consecutive quarter. The CEO attributes the solid results to remodeled stores and marketing efforts. Big Lots was up lots today, nearly 14% to $36.18. Navistar missed on earnings, but revenue beat forecasts. The truck and bus manufacturer was hurt by one-time pension expenses. Navistar also set strong full-year guidance. The shares fell more than 3.5% to $33.85.
Vail Resort second quarter earnings topped estimates, but the ski resort operator did reiterate that it is lowering its 2019 guidance due in part to fewer guests visiting its U.S.-based resorts during the pre-holiday season. Vail also, by the way, announced a 20% increase in its dividend, and shares rose nearly 7% today to $216.55. Citrix Systems has been hacked. The networking software company said today it has taken action to fix the problem and that the unauthorized access was possibly done by international cyber criminals. Citrix did contact the FBI and is cooperating with that agency's investigation. Shares fell more than 2.5% today to $99.98.
It is time now for our weekly market monitor who likes food stocks. He says there is value in food, but it's all about picking the right company. This is his first time on the program, so we welcome Kevin Dreyer, Co-Chief Investment Officer of Value at Gabelli Funds. Nice to see you, Kevin. Welcome.
Hi, thanks for having me.
So, I mean, everybody's got to eat, but to your point, there are a lot of players in the food space, and you've picked three that you think will continue to perform well. One, and they all have a big footprint, but ConAgra is your first pick. Why?
Yeah, so ConAgra really is focused in a couple areas. One is snacking, and the other is frozen foods. So these are two of the faster growing areas within the food sector. They have leading brands like Banquet, Healthy Choice, Marie Callender's, and many others. And they just bought another company, Pinnacle Foods, which we think that management CEO Sean Connolly is going to be able to do quite a bit better with those brands, putting them together with their own.
Another one you have, Kevin, is Hain Celestial. Of course, they're into everything from seasoning to yogurt. I just looked at a 5-year chart today. 4 years ago, this was a $70 stock. Today, it's a $20 stock. They have a relatively new CEO, just started last fall. I guess you're placing a big bet on him, yes?
Yeah, so this is a bit of a turnaround play. Hain is really focused on the natural and organic market, which is only about $80 billion out of the $800 billion food market in the U.S., but that market's growing about 8% versus 1% for overall food. So they're really focused on the right areas, but they just need to restructure the business a bit. So we think that new management is going to be able to come in and do that, and then they should get more than their share of the growth of that faster growing natural and organic segment.
Next is Mondelez. It's not only a domestic play, but it's an emerging markets play as well.
Yes, exactly. The other two were a little bit of turnaround plays. This one is really a high-performing company. They're in snacking. They have well-known brands like Cadbury, Ritz Crackers, many others, and 40% of their business is in developing and emerging markets. And if you look at certain markets like India, their scale is really unsurpassable by other companies. So they have very, very deep roots in these markets, which is going to propel both top and bottom line for years to come.
So I'm curious, you're picking food. Is it because of the value you see, or are these just classic defensive plays at this cycle in the bull market?
I mean, they should be relatively defensive in the scheme of the market, but that's not why I'm picking them. They're really, we think, very good businesses that have some interesting things going on with all of them that we think can surface value in the next couple of years.
Very quickly, if the global economies are slowing down, is Mondelez vulnerable because of the percentage of their sales that they get from overseas and emerging markets?
To an extent, but really when you see the emerging middle class, in all these emerging markets, one of the first things that consumers do is they look to buy branded food and beverage products. Mm-hmm. So I don't think that would be one of the areas that consumers would look to be cutting. They are always subject to currency risk. For instance, they have a sizable UK business if there's a hard Brexit. So that is a risk that's out there.
Kevin, thank you so much for joining us.
Great, thank you.
Kevin Dreyer with Gabelli Funds. And coming up, retail returns to its roots with a new kind of brick and mortar store. It's tonight's Bright Idea. The U.S. women's soccer team is suing the U.S. Soccer Federation. All 28 members of the World Championship team allege gender discrimination that affected everything from their pay to medical treatment to travel arrangements. They are seeking class action status so that past players can join. This lawsuit mirrors similar accusations made in a 2016 complaint filed by 5 players with the Equal Employment Opportunity Commission.
Well, today is International Women's Day, and what better time for Marvel's first standalone female superhero movie to hit the silver screen, which it's doing this weekend. And a lot is riding on the success of this latest release. Julia Borston has more.
Captain Marvel may have the superpowers to turn around a struggling box office with the highest pre-sales in a year. The film is projected to gross up to $150 million in North America this weekend. That would eclipse the $103 million that the other female superhero, Wonder Woman, brought in over its opening weekend 2 years ago.
When you put a woman front and center in one of these films, now there's a lot more attention on it because the box office is so big. We're talking hundreds of millions of dollars in the global box office. And so Wonder Woman, I think, really kind of kicked off that momentum in terms of this new era of superhero movies, and Captain Marvel is looking to sort of continue that.
Where's your head at? The reviews so far have been good, an 82% score on Rotten Tomatoes. And it's not just Disney's investment in a $150 million plus budget on the line. Brie Larson's character could drive or dampen interest in the 4 other Marvel films coming this year. Up next, Avengers Endgame next month. Then this summer, Sony's Spider-Man Far From Home, and Fox Max, soon to be owned by Disney, has 2 X-Men movies, Dark Phoenix and The New Mutants.
Here you are, enjoy.
And theater chains are counting on the superhero to lead a turnaround. The box office is down over 25% year to date. Not even accounting for inflation, this year is the lowest grossing start to a year since 2011. After last year, the box office hit a record, bolstered by Black Panther.
Anticipation is sky high. This is going to be a $100 million opener, and it's going to sort of put the box office into an upswing, and it's going to kick off a 2019 that is gigantic for Disney.
Studios and theater chains alike are hoping this weekend will kick off a box office turnaround. The decline so far this year fueling concerns that the rise of streaming alternatives is raising the bar for the increasingly pricey trip to the movies. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Retail stores are continuing to close in droves. More than 4,000 are scheduled to shut their doors this year. And if you're a landlord wondering what's next, you might want to pay close attention because a trio of New York City entrepreneurs got the bright idea to create a space billing itself as the world's most interesting store. Shopping has always intrigued Tal Zvi Nathaniel. His mother dressed storefront windows in Israel, and he's inspired by the grand department stores of the 20th century. Selfridges in London is a favorite.
It was always about, you can stage anything that you want, so there's always a lot of magic.
Arriving in New York back in 2012, though, he found the storefronts lacking.
The first thing I noticed was, where's the magic? None of those things that me and my friends are buying or interested in are there.
The magic may have moved online. New products, cheap prices, but few digital startups have the time or the money to find and open physical stores.
Almost kind of looks like a gallery.
So Nathaniel and his team opened Schofields in December of 2018. Located in downtown Manhattan, it's a gallery of pop-up stores and works of art. Yes, that's for sale too.
We want to offer you flexibility. You don't have to commit to 15 years. You can just come for 3 months or 4 months. You don't have to commit to a specific store size. You can try different types of footprints.
Short-term pop-ups can cost $250,000 in New York City. But Schofields is renting spaces for $6,000 to $18,000 a month. Nathaniel and his co-founders Amir Zwickel and Katie Hunt took the risk on a 15-year lease with a landlord willing to try something different.
Innovation in retail is something new to landlords today. They understand that something new needs to happen. You kind of only walk in here, you get this wow. People like to think that retail is dead. Retail is completely not dead.
The first floor is home to wellness products like Frank Body, a line of Australian coffee scrubs.
You can try all of them here and then literally press the button to vote.
Quip has sold 1 million electric toothbrushes online, but it wasn't equipped to find a physical space.
You have to think through all the operations and logistics and then start from scratch to build that experience. And with Schofields, of course, you get kind of a helping hand the whole way.
Cool to go right up here for spring.
It's a problem Hunt has seen before. She was employee number 3 at eyeglass maker Warby Parker, which began online and now has about 90 stores.
We didn't have that ability on the team, and we actually had to hire for it. I want to take that fear out of the decision for the brand that we're working with.
Zwickel is leading the hunt to find and design more retail spaces.
That's the most distressed submarket in the US at the moment. Tal comes from the consumer world and I'm from the real estate world, and both of us recognize the same problem from different sides of the business.
First, Schofields will expand upstairs. Later this month, shoppers will get access to a slide connecting the 3rd floor to the 2nd. On the 4th floor, an event space and an outdoor terrace, each a nod to the old-time department store magic.
It's a big thing, try to walk in the footprints of giants like that, but it also gives us a lot of power when we look ahead.
And that building in Greenwich Village was home to the first animal hospital in the United States, so the co-founders like to think it has good karma. They are hoping to begin work on sites in other major cities later this year.
Before we go, one final look at the day and the week on Wall Street. 5 straight down days, finishing with today down 22 points on the Dow. The NASDAQ was down 13, the S&P down just 5. And for the week, down 2% plus, the worst week of the stock market in 2019.
Wow. That does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for watching. We'd like to remind you that this is the time of year your public television station seeks your support.
I'm Bill Griffith. Thank you very much for that support. Have a great weekend. We'll see you Monday.